Hey traders! Today we're diving into a vital yet often misunderstood aspect of trading: stop-loss strategies and risk management. Setting effective stop losses can protect your gains and limit your losses, whether you're trading stocks, crypto, or forex. In this video, we'll cover the basics, share tips on avoiding common pitfalls, and discuss the psychology behind stop-loss placement. Let's start with the basics. A stop loss is an automated order that closes your position if the market moves against you, limiting your losses. However, the challenge lies in setting it correctly. Too tight, and you might be stopped out prematurely. Too wide, and you risk larger losses. One common mistake is setting stop losses too close to the entry price. For example, if you set a stop loss at 5% below your entry price on a volatile stock, a minor fluctuation could close your trade at a loss, even if the price recovers soon after. In volatile markets like crypto or tech stocks, consider setting your stop loss at 10% to 15%. Imagine buying a crypto asset at $100 and setting a stop loss at $95. A quick dip might trigger your stop loss, leaving you with a loss when the price bounces back up. Using the average true range indicator is another effective approach. ATR measures a stock's average volatility, giving you insight into how much it typically fluctuates. Placing your stop loss at 1.5 to 2 times the ATR helps avoid being stopped out by typical price movements. Example, if a stock's ATR is $2, setting your stop loss $3 to $4 below your entry aligns it with the asset's natural volatility. Many traders worry about stop-loss hunting, a practice where market makers intentionally trigger stop losses at popular levels, like $50 or $100, causing a dip before prices recover. To counter this, try setting stops just below support levels instead of round numbers, like setting a stop at $98.75 rather than $100. Setting a stop loss too wide can create a false sense of security. While it may avoid getting stopped out by small fluctuations, it also increases your risk exposure. For instance, if a trade setup suggests a 5% stop, placing it at 10% could result in larger losses when the setup fails. Example, imagine you enter a trade with a target reward to risk ratio of 1, aiming for a 20 pip gain with a 20 pip stop loss. If you widen the stop to 25 pips, you'd need a higher success rate to maintain profitability, making the strategy riskier. Psychology often influences traders to set wide stops. Fear of taking a loss can drive traders to give trades more room, hoping the market will reverse. Overconfidence in a setup or clinging to past success with wider stops can lead to larger than necessary losses. Remember, the market is unpredictable. Sometimes it's better to accept a small loss and move on. A trailing stop is a dynamic way to lock in gains. This stop loss moves up as the price rises, keeping a set distance from the peak. If the price continues upwards, so does your stop, allowing you to capture profits while protecting against downturns. Example, if you buy at $50 and the price rises to $60, a 10% trailing stop will adjust from $45 to $54, preserving gains as the price climbs. Stop losses are just one part of a broader risk management strategy. Position sizing, allocating a certain percentage of your capital to each trade, is equally important. A common rule is to risk only 1% to 2% of your capital per trade, which protects your portfolio from large losses even with wider stops. Example, for a $10,000 account, risking 1% means limiting each trade's potential loss to $100. If you're trading a stock at $100 with a 10% stop loss, invest only $1,000, so if the price drops to $90, you're within your risk tolerance. Some platforms offer AI-based tools that analyze your stop loss placements. By simulating trades with different stop levels, those platforms can show whether tighter stops would improve results. This data-driven approach can help you refine your strategy for better outcomes. Here are some practical tips to improve your stop-loss strategy. 1. Analyze trade performance, review trades and experiment with tighter stops. 2. Adapt to market conditions, adjust stops for volatility in different market environments. 3. Avoid emotional decisions, keep your approach data-driven, not emotion-driven. 4. Consider partial profits. Take partial gains when uncertain, letting only part of the trade run. 5. Monitor adjustments. Track performance over time to see if your adjustments improve overall results. Let's recap. 1. Avoid setting stops too tight to prevent unnecessary exits. 2. Use the ATR indicator to adjust stop distance based on volatility. 3. Avoid stop-loss hunting by placing stops just below key support. 4. Try trailing stops to lock in gains as prices rise. 5. Limit risk with proper position sizing and tools like Hawk Trade to optimize stops. By following these steps, you'll be well prepared to protect your capital and maximize profits. Thanks for tuning in. If this video helped, don't forget to like, subscribe, and hit the bell for more trading insights. Let me know in the comments, what's your approach to setting stop losses? Until next time, happy trading and stay disciplined.